Hi, welcome to our market analysis report. This is Tanya, and we've got Jay and Tommy with us as well. So in our market analysis report, we as currency exchange traders will be analyzing two currency pairs, which is the Australian and US dollar, and then the euro against the Japanese yen. We'll be using economic indicators in order to help us raise capital or be a price maker in our next dealing sessions, and we'll speculate in the short term between 3 to 6 months. And we'll be using fundamental and technical analysis to predict past, present, and future behaviors. So now we'll analyze the Australian dollar against the US dollar.
According to Trading Economics, the Reserve Bank of Australia has kept its interest rate at a record low of 1.5% for the 19th month in a row, suggesting that the current interest rate is stable and unlikely to change. However, Trading Economics indicates the United States interest rate has increased from 1.5% to 1.75% during March 2018, with officials predicting a sharp increase in the interest rate during 2019 and 2020 as the US's economic position improves. However, it should be noted that with a steadily rising interest rate, the inflation rate is expected to increase as well, eroding much of the potential interest rate. Currently in the United States has a higher interest rate than Australia, meaning the USD is likely to appreciate against the AUD because of its higher interest rate encourages capital inflows from surplus economic units, increasing demand for the USD relative to the AUD and discouraging capital outflow to Australia from surplus economic units because the USD has a higher interest rate, decreasing the supply of the USD relative to the AUD.
According to Trading Economics, the current inflation rate in Australia is 1.9%. The RBA has an inflation target of 2 to 3%, as this is the rate that should be low enough so that it does not distort economic decisions. Since the inflation rate is lower than it should be, Australia will face more demands for exports and will therefore have more demand for the AUD, whereas imports will lower causing less supply of the AUD. The current inflation rate for the USA is 2.4%, with an outlier from the global financial crisis. The US has a higher than average inflation rate. This causes for less demand in exports and therefore a less demand for the USD, whereas imports will be higher and there will be a large supply of the USD. This shows that in the case of 1 USD to 1 AUD, the American dollar will be devalued by 0.5% against the Australian dollar. This can show that the Australia will theoretically be able to purchase more goods in the US if the exchange rates were equalized.
Australia's current economic growth rate is 0.4%, whereas the US economic growth rate is currently 2.9%. This means the GDP of the US is growing by 2.5% more than the Australian GDP. The higher level of economic growth rate of the US indicates that there is an increased demand for imports from Australia, which will shift the supply curve to the right, according to the AUD to depreciate against the USD.
Government intervention in Australia, with the economy in order for it to be as efficient as possible, adjusting taxation, subsidies, having the RBA create demand and supply for the AUD against a foreign currency are the necessary conditions that the government adjusts to make the economy as efficient as it can be. Australia is also rich in natural resources, so we export a lot of commodity goods to foreign countries. 45% of goods exported are a composition of minerals and fuels for the year of 2016-2017. The government in America intervenes with the economy as it helps prevent the economy from being too volatile and make sure that the USD stays stable and does not fluctuate constantly. The US is a major exporter of machinery goods of up to 24% in 2016 to 2017 exportation. Much of the increase in exportation is due to increased employment, as such as the employment rate has decreased from 4.1% in 2018 from 4.8% in 2017. The Australian dollar against the American is slightly depreciated. This can be influenced by the RBA, who are taking high risk in foreign exchange in order to have the Australian currency stable in the foreign market. Overall, the expectation for the next few months can be expected to remain relatively steady at both around 0.77 for the offer and ask rate. It is possible that the rates can fluctuate between 0.75 to 0.8.
Okay, now we'll talk about the euro against the Japanese yen. The ECB has kept the interest rates at 0%, whereas the Bank of Japan has kept the short-term interest rates at minus 0.1%. These low interest rates indicate the economies are trying to boost their economic growth and encourage more consumer spending. These low interest rates reduces borrowing costs for companies and households, as well as encourage consumers to save less. A lower interest rate is also bad for investors, as the rate of return will be lower, and they'll probably get a better rate of return in the EU. Japan's lower interest rates means there will be less demand for the Japanese yen, causing a fall in its value. And with the Japanese yen being less desirable than the euro, the Japanese exports will be more competitive and imports will be more expensive. With the inflation rates, the EU has an inflation rate of 1.3 and Japan has an inflation rate of 1.5. This is Japan's highest inflation rate since 2015. This indicates their cost of living has gone up significantly. Economists have argued that Japan's core problem is deflation and that only by breaking deflationary expectations could the Bank of Japan convince companies and consumers to invest and spend, thereby jump-starting a new cycle of growth. But growth has increased even without a significant change in inflation expectation. This suggests the roots of Japan issues are in excessive regulation, poor corporate governance, and an aging population. Japan has a higher inflation rate than Europe, indicating there will be a decrease in demand for exports from the EU. This will lead to less demand for the Japanese yen. Conversely, there will be a demand for imports from the EU, causing for an increased supply of the JPY. With this, the Japanese yen will depreciate against the euro as the domestic products become less competitive. If 1 euro equaled 1 Japanese yen, at current inflation rate, the euro is devalued by 0.2% against the Japanese yen. The law of PPP and adjusting exchange rates will show Japanese yen will be able to buy more goods than euro. With the relative growth rate between the two countries, the EU GDP grew by 0.6%, whereas Japan's economy grew by 0.4% quarter on quarter in December 2017. This was the eighth straight quarter of expansion due to strong private consumption and upward revision of business spending and inventories. EU's higher levels of economic growth will cause further demand of increased imports from Japan, which will shift the supply curve to the right, meaning the euro will depreciate against Japanese yen.
The EU currently operates as a single market with 28 currency countries, making a world trading power. This number is expected to drop to 27 soon as Britain prepares to leave the EU. The main issue facing the EU now is Brexit, with both governments currently trying to make trade deals. Without a trade deal put in place between the economies, trade would stagnate significantly due to the introduction of large tariffs. According to Parrington, this would hit Britain the hardest, but is expected to cost the EU around 100 billion euros. Hence, government intervention is necessary in the EU to maintain current levels of economic growth. While it is likely that Britain and the EU will come to a trade agreement to prevent costs from trade tariffs and slower transportation of goods, it's not guaranteed. This increased level of risk from the uncertainty of government intervention should be considered when investing in the euro.
So with Japan, almost half of Japan's economic activity comes from exportations, and the Japanese government and the Bank of Japan wants to keep the yen relatively weak so they can encourage more overseas sales and remain competitive in the world trade, especially when competing against China and other cheap exporting Asian countries. The Bank of Japan and the government has said it will continue to buy Japanese bonds until inflation exceeds 2% and stays above the target in a stable manner. The two governments, the European Union and Japanese government, has built an economic partnership agreement where Japan will cut 90% of tariffs on EU exports to Japan and vice versa. And prior to that, there were high Japanese taxes, like 40% tariffs on beef or 30% on chocolate, and this will encourage more exports and imports between the two nations. We currently predict that the Japanese yen will depreciate against the euro, but there will be high volatility with the euro, especially when next Wednesday Eurostat will release the Eurozone inflation data for the month of March. This will be watched closely by the European Central Bank. World trade wars and trade agreements between Japan and the US has attributed to euro's current weakness as well, and there's also impending North and South Korean talks. Every single currency in the world really relies on the US and how it goes in the next 3 to 6 months.
In summary, we can see that the Australian dollar is currently weaker than the USD. and the euro is stronger than the Japanese yen, based on the info provided below. Thanks for listening.